Well, again, good morning, and thank you for joining us this second day of November, the second day of the open enrollment season. I know many of you are very busy going into the season with both your under and over 65 business, so thanks again for taking the time to get some information from one of our carriers. Again, to this morning, we're going to have North American with us, and Charlene Thardelson has been with us on a number of occasions and presented different products and different selling ideas, actually. She does a great job of bringing that to your attention. And this morning we're going to be looking at one of the products that I personally have favoritism for and actually find myself selling quite a bit. Before we get started, let's look at the housekeeping first of all, and let's make sure your phones are muted. Should be by the system, but just in case. Again, we're going to ask that you keep all your questions until the very end by typing them into that box on the left or the right-hand column, and we'll address them in the end. And then, of course, stay with us until the end so you can find out about any special bonuses to be offered with the sale of these products. So with that in mind, again, thank you. And Charlene, please take over.
All right. Thank you, Mark, and thanks, everybody, for joining us early this morning. I guess a little earlier for me. I'm on the Central Time Zone, so just a little bit after 8 o'clock here. But I got my coffee, so I'm ready to go. Yeah, so today we're going to focus in on some of North American's products that offer a guaranteed death benefit. And I'm just going to walk you through that, highlight a few of the features and benefits that go along with that, and hopefully give you a couple of ideas to walk away with. And, I want you, as I'm going through this, to think about your client, who this would be a fit for, and, make sure that you jot those names down because you're going to want to try to put this into action just as soon as you can. So with that, let's just go ahead and get this started. So why are life insurance guarantees important? Well, in almost any economic environment, and especially during challenging economic times, products that offer guarantees, that aren't going to change or lose their number of years that they're going to, provide the benefit that the client thought, those guarantees can be really important and a safety net. And so this holds true for life insurance. I mean, there's other products and services that people buy with guarantees. I mean, think about a car that you buy where you get a warranty or a TV or a refrigerator. They just offer a little bit extra peace of mind. So when talking with your clients about life insurance, some of their common responses, when you're discussing the options is, they're going to say things like, I want a level premium. I want to know what my premium's going to be, today, and it's going to be locked in and that rate all the time. I want it to be competitive at a stable and have a stable interest rate. I want to know what it's going to return. I want that death benefit to be guaranteed. And we're going to talk about how they could be looking for a guarantee for a short period of time or one that they can't outlive. We've got products that can fit both of those needs. And wanting that life insurance product that will last their lifetime so that they don't have to make changes over time. That's going to be our GUL products, guaranteed UL. And that's what we're going to show you. So all of this together offers your clients peace of mind by having strong guarantees. So the agenda of what we're going to go through today is we're going to start by looking a closer look at why life insurance guarantees to fully understand how they work, those client objectives, how the concept can benefit your clients. Then we're going to spend a little time looking specifically at North American products. And then I just want to bring it all together by looking at a couple of sample case studies and discuss some of the key items that you'll want to consider and be aware of when presenting a guaranteed life insurance product to your client. So with that, let's go ahead and just move into our agenda. Why life insurance? Well, there are two key guarantee sales goals with life insurance. Usually it's that death benefit guarantee and determining for how long that they want it. Of course, there could be some people who, besides the death benefit guarantee, are looking at cash. And we're going to show a mixture of that on one of our products. But usually they want that guaranteed death benefit, and so either we need to know if cash value is a part of that equation of what they want, or if it's strictly just the death benefit guarantee. And there's going to be a difference in cost for that, because if you want both, then it's probably going to cost a little bit more, but you might be surprised that it might not be that much more. And also, we talked about that they might want to know that their premium is locked in, that it's not going to keep changing over time. There are ways that we can solve for the premium to guarantee it all the way, out to 120, and we're going to have them pay to 100. Our products are designed that they pay to 100, and then from 100 to 120, we don't charge any cost of insurance. So if they're okay with paying all the way to 100, that's one way you can design it. But other clients might say, you know what, I want to have this paid for by the time I retire, which might be 65, might be 70. Or maybe I want to have it paid for, I want to pay it up in just 10 years and just be done with it so I don't have to worry about it. Those two are all options that give you some flexibility depending on your client's needs. Now, when they say they want cash value in there, then we're going to look at another product that offers that guaranteed death benefit and the possibility of some cash value accumulation. So with life insurance, obviously there is that immediate death benefit protection from day one. So even if it were $1 million death benefit and they're going to pay X dollar amount each year, it doesn't mean, as soon as the policy goes in force and the premium is paid, that $1 million can pay out the next month or the next year if death occurs, prematurely. So they automatically have it from day one. The other thing is that a death benefit, when it's paid out due to death, that goes to the beneficiaries tax-free. So there's a huge tax benefit there. And so some of the ways that a guaranteed death benefit could be funded is you might have clients who have RMDs that they don't even need. This might be a good way to leverage it into something of a tax-free death benefit for their heirs later. Those could be their payments that they're making on the policy. Or it could be a single premium even. Maybe it's an asset transfer. So it's a way to really leverage those dollars into so much more and have it go tax-free to their beneficiaries. The next bullet here is about tax-deferred growth, and that's referring to the premiums that are paid in when it's a cash value product and it's building cash value based on how an interest is earned based on how an index performs. As the policy earns interest, that's deferred. We don't send out a report each year to say how much interest they earned and that they have to report that on their taxes. Unless they access the cash, it doesn't become, and how they access it could keep it tax-free, but that growth is inside and it's tax-deferred. And again, if the policy is paid out as a death benefit, then any gains that were in the contract are not passed on to their heirs. A policy with cash value also offers liquidity. So should their needs change and they have cash value in the policy, it can go with them as an exit strategy. So if they decide to 1035 it into the new upcoming product that we don't even know of yet that comes out in 10 years, they can transfer that money by way of a 1035. If they're in a policy that doesn't have cash value, then they're a little bit more limited. They wouldn't really have anything to take with them. And you'll see that in the illustrations that I'm going to share with you here a little bit later. We're going to move into a couple of our products that offer the guarantees and just help differentiate why you would choose one versus the other. So what I've got here is our custom guarantee, and this is a product that is, you could call it like a term to 100 or term to 120. It never really builds or accumulates cash value, regardless of how much extra money you put in. It never really, that cash never really sticks. There are some early cash values, but really, again, never much to feel like you're earning cash in there. But the premiums are lower to guarantee that coverage. And this product has low minimum face amounts that you can start with. So while we don't have like a typical final expense policy, this is the lowest that our product can go. Is we can go down to 25,000 on this if the clients are the older ages, 60 to 85, and then if they're younger, the minimum face amount is 50,000. And like I mentioned before, a client that wants to have this for their lifetime that they won't outlive, and this is assuming with today's um, medical advances that people aren't living past 120. I think we've heard of some 114s and 112s recently. But when they get to age 100, there's not going to be any more premiums or cost of insurance, and it's automatically going to continue to 120. Now this product, we talked about this the last time I presented, I believe was the 3 sales in 1, where this policy, this product, because it doesn't build or accumulate cash value, there is an exit strategy that's built into the product or a feature, and it's called this guaranteed exchange provision. So if your client later says, boy, I sure wish there would have been some cash value in here, this works a lot like a term conversion. So they can exchange this without having to go through underwriting and go to one of our other products like the Builder or the Rapid Builder that builds cash value. And so it's just an easy change internally here at North American. We do issue a new policy number, and of course, the specifics of, say, the Builder. But that's a great feature to know that you can start here at the lower cost and be able to change to a product that builds cash value later if that is desired. This product does have a 2-year rolling target. That's for you as the agent for which your commissions are based on. Based on the way the product is designed and illustrated, maybe the target is 1,000, but the client's premium only needs to be 800 that year. So when they pay their $800 premium again in the second year, then the first 200 of it, the difference between 800 and 1,000, you would still earn first-year commissions on in the second year. And the thing about that 2-year rolling target, it does require that 80% of the premium is paid in year 1 in order to get it to roll over to year 2. That guaranteed death benefit, even though I've talked about 100 and 120, that you could even dial it down. Maybe your client says, the longevity in my family history shows that, we don't typically make it to 90, so you could dial it down and go 90 or 85 or 95, and there would be a slight difference in premium, but I would encourage you to look at the difference between that premium and the one all the way to 120, because you might be surprised. It might be pretty minimal, and it might be worth it to pay that difference. Also, if you look at the designs on a shorter pay, like pay to 65 or 70 or pay for 10 years or 20 years, you might also see that, boy, if I pay it up in a shorter amount of time, I can actually save myself a lot of money versus paying it all the way to 100 if they should live that long. So I would encourage you to look at those two and present those as options to your clients. Let them decide. If something changes once you start in on a 20 pay and they can only pay it for 3 years and then want to change back to the other, there is that flexibility within the product. We would just have to order a new in-force illustration from that point to figure out what that new premium would be. And then those lower face amounts that I talked about, a lot of companies have their minimum face amount as 100,000. With us being able to offer 25 or 50, depending on their age, the one thing that we want to make sure that you know is that if your client qualifies for super preferred, they still can get that at those lower face amounts. Other companies that offer lower face amounts might say that if you're going to be under 100, then the best we're going to give you is standard. So that's a great option to know that your clients are going to get when they get those lower face amounts. Now, our next guarantee product is our Guarantee Builder, which is an IUL product. And while some of you might be new or not even new to indexed UL, is what I was going to say, is that, I don't want you to be afraid of this because it still offers the guarantee element. And so that is regardless of what the index does or doesn't, as far as does it perform well or not. The guarantee is going to be locked in based on the guaranteed lowest interest rate of 3% that the product offers. So it's not dependent on the index performing at a certain amount. But if the index does perform well, that's all extra for your client, and that adds to that cash value, adds to that flexibility, adds to if they need to skip premiums, that there's some cash that builds up in there, adds to the point that if they needed to kind of an emergency, maybe they need to get their hands on some money. If there's cash value build up in there, they could access that and take that out. The first product I talked about isn't going to have that little extra slush fund that could build up in there as a result of good performance. So this one does offer that. Likewise, this one has a minimum face amount of $25,000. We mentioned the variable loan rates or fixed or a net zero cost loan here. Those would all be important if the client ever were accessing the money. Just ways when you take it as a loan, that cash value growth was tax deferred, and if you take it as a loan, then it stays in there as tax deferred. You're not considered to be permanently pulling it out of the policy, so it doesn't result in a taxable event. And the overloan protection and the protected death benefit are built into the product. So those can be important if the loans ever get to be sizable. So I won't go into more detail on that, but they are added to the product up front as part of the product. You don't have to ask for them, and they're there for your client's benefits in the future. And because it's an IUL, between you and the client, you're going to help them decide which index the client should choose and allocate their funds to so that they can see what kind of performance they can get over time. And we have 13 different index choices, but they can just choose one, or they can choose two at 50% apiece, whatever. It doesn't matter. Those choices are up to them, and they can change them over time. They're only ever committed to an index selection for a 1-year period of time, and then they can change afterwards. And they can change with ongoing payments as well. So lots of flexibility there. There's an interest rate bonus that's guaranteed in this product once we get to year 11. That's when it kicks in, and it's 75 basis points. So an IUL policy has a floor of 0 each and every year. So if the index performs, and results in a 2% loss, well, then we just use 0 and don't credit anything. But what happens with how this bonus plays into that is once you get out to year 11, the floor actually now, because the bonus is added on top of the floor, essentially the floor is now 0.75 instead of 0. So that's a great added benefit for your client. Daily sweeps just means the day we receive your client's premium is the day we put it into the index allocation of their choice. There is a fixed account, which currently credits 3.75 and has a guarantee of 3. So they could put money in there, and then that would be more guarantees too. But why not see what the upside could do? So like I said before, this is a guaranteed product, but it has that cash value element, which might be desired by some of your clients. And when you look at the premium differences, you might be surprised that it's really not all that much. And because we're talking about guarantees today, I definitely need to include the term because that is a guarantee. That's locked in for a certain period of time. So you can see here we've got a 10, 15, 20, and 30 years. Of course, those are locked in for those. But, a 30-year-old who gets a 30-year term, what's he going to do at 60 when it renews and the premium goes sky high? Our term products are very competitive in price. But what's more competitive about our term is the conversion privilege. We also talked about this the last time I presented for you on the 3 sales in 1, where you have this conversion privilege. So this is going to be the lowest way to lock in their insurability and premium for a death benefit that they need and desire. And if you exercise the conversion during the time that's allowed, which is always at least 5 years, but otherwise, depending on their issue age and the term of the product, it's going to be up to age through 74 or through age 69 on the 30-year. And the banded product, that bullet point right there, just means that we have different bands, basically at 250, 500, and $1 million. So if your client only needs 475, it might actually be cheaper to get them 500. So go up to the next pricing band, kind of that, the more quantity that they buy, the lower price per 1,000 it would be. All right, so just why you might use that term, just for that specific amount of time to cover maybe a mortgage or until um, something else is paid off. But it's really inventory to be converted later. So think of term like that, inventory to be converted later. All right, now our custom guarantee and our guarantee builder both have the accelerated death benefit endorsement. So these come along with the policy as long as the client's underwriting rate class is in the approved criteria, so table 4 or better for chronic and table 2 or better for critical. And then there's age requirements like 75 and 80, and those will be included. So these are ways, especially on that custom guarantee where you're not building cash value and you only have the death benefit, these are living benefits. So if the client becomes chronically or critically ill and wanted to take money out of the cash, we didn't have cash, but this is a way they can accelerate their death benefit for some living needs if they fit the criteria for critical and chronic. And just real quick here on these next couple slides, I guess it looks like we go into a little bit more detail on the terminal illness. One thing that I'll point out here that is pretty generous from North American compared to other carriers is that we say a 24-month life expectancy for terminal illness. Other carriers might not let you accelerate it for terminal illness unless you're within a 6-month or a 12-month window. So if your doctor says that your life expectancy with this illness is 24 months or less, you would have the ability to accelerate up to 75% or 750,000. So that's important to know that you have that feature in there. The critical illness, again, this is included, but this is for specific medical conditions, and these are things like a heart attack, cancer, stroke, major organ transplant, or kidney failure. Again, this lets you accelerate the death benefit for living benefit if you meet those conditions. You haven't paid for this to have this benefit on there, so when we pay out the benefit, we do discount it, and that's how it's paid for when you use it. So you're not paying for something that you might not ever use, but you're paying for it when you do use it. And so this one allows you to accelerate up to 50,000. And then it's discounted, so the most in that example the client would get would be 20,000. They're going to accelerate 50, their death benefit's going to be reduced by 50, but they're going to get a check for 20 to help with their critical illness. Chronic, on the other hand, is more for the permanently being unable to perform at least 2 of the 6 activities of daily living. Then they could qualify to be able to accelerate this. And this again, just like the last one, they haven't paid for it until they actually need to use it. So they can accelerate up to 24% or 240,000 every 12 months once their doctor certifies them as being permanently unable. There is a discount approach there as well, and that can all be calculated and looked at in the software. The guaranteed insurability rider is an add-on rider. This is another way to offer some guarantees for your client, and it would be your younger clients. This would be on the custom guarantee currently now is the only product it's available on, but it's a way to lock in the insurability. And like I like this, I have this for my son. So when my son got his policy at 10 or 12, you get a small face amount, maybe 100,000. But then I was able to add a $50,000 GIR rider on there. So at certain ages, I believe it starts at 23, and every 3 years after that through the age of 40, I think that gets us our 10. He's able to increase it by 50,000 without having to go through underwriting to prove his insurability. So he could have become a smoker since then, and we can't hold that against him. He could have gained a bunch of weight since then. We can't hold that against him. He could have developed diabetes or some other illness or ailment that makes him rateable. And again, we can't hold that against him. So he can take some or all of those $50,000 increases. Every time he does, of course, it increases the death benefit, and then likewise probably going to have to increase the premium. So I said that's only available in the custom guarantee. We should be adding it to the guarantee builder probably sometime next year. Let's see. I kind of want to get to these illustrations because I see that since the last time I presented this, they've added a few more slides, so I apologize for that. So as far as positioning and presenting the guaranteed, a strong on guarantee product to your client, we have a nice age range that you can be utilizing for issue ages. So all the way to 15 days, all the way up to age 85. They are going to be somebody who's looking to lock in not only their insurability, but to secure a death benefit that can be guaranteed either for a certain period of time, either to a certain age, or all the way for their lifetime, something that they won't outgrow. The clients that you should also be looking at as far as not only getting those younger people and their children and their grandchildren, but as far as people who want to leave a legacy for their children and grandchildren. So people within those retirement ages, I had mentioned earlier that if you've got clients who have RMDs that are, they're kind of at that point where they have to take them, but they're really just putting the money somewhere else, they're not using it. This could be a great opportunity for you as a legacy building concept to build more of a death benefit for their heirs rather than just moving those RMDs to, say, a savings account. So for when you're sitting down with your clients and you run across a sum of money or find that they have RMDs that they're not using, ask them, what are you doing? I see you're taking the RMDs and putting them over here, or I see you have this large sum of money sitting in a savings account, not really earning, not really being accessed. If you come across some of those funds, those might be ideal for this next opportunity here. So let's go with, of course, they have to be insurable. So we're using life insurance here, and we need to know that they're going to be insurable and have, be able to meet the underwriter's criteria for needing the added insurance. But if they also want some cash value and to leverage that to more death benefit, let's see what we can offer them here with a North American product. So here I've got a case study for you. This might be a client that you ran across, a 65-year-old female who is in a standard non-tobacco rate class. And you find that she's got this $50,000 setting somewhere that she really would like to leave for her family. So let's see what we could do with that by leveraging that as a lump sum into one of North American's policies. In this example, let me grab a highlighting pen here. Here's our 65-year-old right up here, standard non-tobacco. And then here's our non-1035, our $50,000 lump sum that we're going to drop into here. Now, if she's going to be able to reach or satisfy that the standard non-tobacco underwriting criteria, we can turn $50,000 into a $117,000 death benefit basically overnight by getting this policy issued. So $50,000 that was sitting in that savings account has now turned into $117,000. Remember, this is going to be tax-free to her family, her beneficiaries. This, if we would have left the $50,000 sitting in a savings account earning interest, when that passed to her heirs, that would have been taxable. So it's a great way to leverage it. And by the way, you're going to earn some commissions. This is the target premium for depending on what level commissions you're at, what you're going to earn on the sale. And so this right away, day one, you can see that because we did dump it in, this is the product that I said doesn't build cash value. But because we put it all in up front, we do have some cash values, but you can see that, they run out really quickly. After 15 years, that $50,000 really went to nothing. And maybe it's out here at age 80 when she becomes chronically ill or something and maybe does need some of the death benefit. She can still access that with those living benefits. The next example I'm going to show you is if we use the Guarantee Builder, which is the IUL. This is our same client dropping $60,000 in. We're getting a $114,000 death benefit versus, was it $117 over here? It was. So is it worth it to the client to be able to guarantee just $3,000 less and This does go all the way out to 120. I'm only showing to age 90 on this page. But would it be worth it to her so that her 50,000 could possibly grow into something more? Here we've got an indexed return of 3.75. Here we're illustrating 7.09. If we look out to, say, maybe life expectancy for her, maybe 85, at 3.75, she still has 47,000 of her 50,000 in there and still a death benefit of 114. But if it were performing at 7.09, her 50,000 turned into 133, and now her death benefit is starting to grow. And look at, if she lives longer, 90, now instead of 114, it's actually almost up to 200,000. And so by having the cash, by being in the index product, we're locking in the guarantee over here in this guaranteed column, which is not dependent on how the index performs. But if the index performs good, her death benefit could be even higher. Our cap on this product is 12.5%. So there could be some years where it's higher and some years where it's lower. But here at least she's got an exit strategy if she decides to walk away at age 80 and move it to another product or just cancel it. She can take 94. Of course, there's a gain from the 50 she put in to the 94 she's at, but she could. The other product, there's going to be a zero right there. Or she could 1035 this into another product, or she could keep letting it ride and letting it grow. So that's the flexibility. Sometimes the difference between that custom guarantee and the guarantee builder, sometimes it's not really that much. So I encourage you to check them both out. And now as I just prepare to wrap up this session today, I just want to share just a few other items with you. We do have quite a great microsite marketing site for you to access, where we've got pieces on legacy building, postcards that, this is a postcard here that you can send out to your clients, and then follow up with a phone call to talk about this idea with them. So we've got materials like this that you can pull right from our site. You can order postcards if that's something that you're interested in to mail out to your clients. There's also a video on the site that you can share with your clients. They're usually a 1 to 2 minute video, so you could definitely share that. And then just to really summarize here what we've talked about, why life insurance? This is a way that you can help your client use today's money to plan for the present and the future and beyond. We talked about how those living benefits can be peace of mind, during the remaining living years, but how they can leverage that into so much more for their beneficiaries. We talked about North American's products, how we've got 3 different products that you can use for the guarantee depending on what they're looking for, whether it's a short period, whether it's the cheapest price and the most death benefit, or whether they want a combination of a death benefit guarantee and cash. We talked about all the extra add-ons that are available in there, how they can move from one product to the other if they started with term or the custom guarantee, how they can take loans if they need to when they're on that cash value product. And then the sales concept, I guess, that we presented to you today was that legacy building. Think of your clients that are, at the RMD age that are taking those and don't really have a place or need to use those. Here's a way that you can position it into something more. Or, just locking in that guaranteed insurability for children and grandchildren using the GIR, or, just the other products as far as a longer guarantee. So the bottom line that we have for you here is that, help your clients leave a larger legacy for their heirs and have it be tax-free. Giving your clients that death benefit protection with all of those living benefits, the terminal, the chronic, and the critical. And for you, as the agent, you've got a sales opportunity, whether it's just the guarantee or a way to build an extra legacy for their heirs, and then all of that supporting material that we have for you as well. So the next step that I encourage you is, I hope you've been thinking of names. Otherwise, take a few minutes as you hang up from this phone call and write down some names. Try to give them a call by the end of this week or within the early next week, and try to secure an appointment with them where you can sit down and position the North American product, whether it's the term, the custom guarantee, or the guarantee builder. You know, Messer Financial will help you with those illustrations if that's something that you need help with, and building a case design for your client. So with that, I'm going to turn it back to Mark. I'm sure he's got a few closing remarks and parting thoughts.
Well, wonderful once again, and thank you very much, Charlene. The information, again, ladies and gentlemen, as presented to us this morning, keeping everything as simple as possible, because sometimes in our business we get confused ourselves, but even more so, we make things confusing to our clients. So again, the simplicity of saying, okay, here's two guaranteed products, the custom guarantee and then the guarantee builder with the IUL. So you don't have to go out there and learn 6 or 7 different methodologies of what you're going to do. You've got 2 areas to target. First off, as always with life insurance, what we're always going to be looking for is the death benefit, that guarantee itself to the client, and then of course adding to that any other features and benefits that will enhance the fact and the reasons that they took out that policy for that benefit. Of course, always keeping in mind and making sure the clients are aware that these benefits from an insurance policy will be tax-free transferred to their heirs. That's huge, especially in today's world, and I think going forward as we see more enhancement in taxes necessary to control our economy. So here's a great place to go. Then always with the products that give you some permanency, the fact that you could have some liquidity and access in the time of need. I think one thing, Shara, that we might want to touch on just in case, because some people might not be familiar with the terminology of an RMD. So if we look at that and we have that required minimal distribution, that's what it is, that's what the signature letters are, and it's going to be something that's going to affect your clients that are 70 and a half plus. So if we keep that in mind, Shara, you want to give a little bit of explanation of what that actually is for them?
Well, so it's going to be money that they're required to take out of another investment vehicle once they hit that 70 and a half. And so what I was referring to there is that, based on what their other retirement funds are that they're living on at that age, and because they've been in retirement probably for some time, maybe by the time they get to 70 and a half and have to take that RMD, they really don't need it. Maybe they're living pretty minimally or they've got everything covered and they don't need those extra funds. So a lot of times what happens is when people are required to take those funds out, they have to. They just take that money and drop it into a savings account or checking account, and then they're not accessing it. So when you're sitting down with a client and you ask them if they're, again, like Mark said, once they're 70 and a half, that's when those RMDs come into play. So if they have RMDs, are they, that they're taking, are they using those funds to live on? It would be a good question to ask. If they say no, I mean, really between my retirement, or my pension or my Social Security, I have enough, so I really just move that. I just take the RMD that I'm required to take, and I just drop it in my savings account in case I need it later. So that's where you might say, that you have, how would you like to see that money do more for you or for your family, for your heirs?
So, and thank you, Charlene. As agents, I think one of the things, of course, that we're always looking for is another sales opportunity. And sometimes the sales opportunity is right in our own backyard, right in our own face. So if you've got that opportunity and you're working with clients that are Medicare age, and you're helping them do a Medicare plan or a Medicare Advantage plan, you might want to dig just a little bit deeper. Now, I know you have to be careful when you're talking Medicare Advantage that you don't mix the life products in. But on the Medicare products, on just a traditional supplement, you don't have to have that concern. But where I'm going with this is there's 2 areas you have to come from. Number one, you've got a client that's 65 plus. you're asking the question as far as the life insurance policies that they have today. There's a good possibility that they took a term product out when they were 20 years old or 40 years old for 30 years, and there's only a 5-year window left on it. Even a better possibility that that term product already expired and they're out of insurance. If their health is good, rather than be looking at final expense products, which to me are an absolute waste of money, I'm sorry, but I think it's terrible that people spend that kind of money, but if it's their only choice because they have serious health issues, that's still a different matter, but it's still a lot of money for a product that they get very little death benefit for an awful huge premium. Run a quote on a Gen 8. Have us run one for you. You'll be amazed. Without a question in my mind, you're going to double or triple the face amount you can provide that client on that death benefit with the same amount of premium dollars that you expose them to on that final expense product. Now, yes, they have to be healthy to qualify, healthy enough to be underwritten, okay? Again, a good point, though, that Shar brought out was that when you're selling that product with North American, and she's absolutely right. Let me tell you, I run quotes all the time. If I run a standard quote vehicle and I put in preferred on a UL and try to get a feeling for all the other companies that might come in with that product, my choices are going to be greatly limited when I go in with the preferred rating. Now, when I go back to standard, of course, all those companies that disappeared will all reappear. So again, a benefit of working with North American that gives you that rate class increase. I'll tell you the truth. I personally enjoy the 2-year rolling target on the Gen 8 product. So you've got a little residual effect, and sometimes when we're in the business, we forget that one of the greatest benefits we have as salespeople in insurance sales is that there is some residual for the efforts that we put forth from day one. So let's go that way. The second thing I was going to mention, I talked about the expiring term, but just as Shar mentioned with the RMD, you've got that client and maybe they haven't got to that 70 and a half yet. Maybe you've got the door opener to ask them in advance, what are they going to do when they hit 70 and a half? Have they thought about that? Have they made a game plan? You could even get started in advance of them turning 70 and a half, have them start the policy now with the premium, and then know that when they turn on their faucet, that they'll use the RMD money to continue that premium down the road, because maybe right now, in that early 60 age or mid-60 age, they're a little financially more solvent than perhaps they'll be later on. So don't let those windows close behind you when they're right there in front of you to get that opportunity to get in the door. Again, as always, this complete presentation today has been recorded. I know a question came up and I didn't see it till the end. I guess she was having trouble hearing that the volume wasn't high enough. I apologize for that, but if you'll go to the Messer website, if you would please, and you can review the entire presentation, and obviously you'll have control of your own computer so you can turn that volume up that perhaps you'll hear it a little bit better yourself. Also, please make sure you take advantage of the fact of getting an appointment with North American. I think you'll find there are enough opportunities that you can run across that this is another carrier you want to make sure you have on your bullet vest so that you can reach in and grab them when you need them and get a quote and run with it. And always, too, I think another point that was brought out that sometimes gets totally forgotten when we're in the business of looking at the product and what extra riders we want to add on. Always look at that guaranteed insurability rider with those people that are younger, because you want to make sure that, as Shar said, anything can happen in their health. You want to make sure that there's a renewability opportunity for them to enhance their coverage even when their health has run into some difficulties. Okay, so tearfully I state to you today, this is our last webinar for life insurance for the year 2016. so that everyone can focus on their building their health business and building those clients that you can come back to after the first of the year when everything shuts down on the health side and go back into your sales of your life business. So again, sadly, I have to report that this will be the last time I'll be with you until 2017. We'll get things up and rolling again. Again, Charlene, thank you for the many times this year that you've come to our rescue with presentations of information to help our agents learn and grow in their business.
Absolutely. Thanks for having me.
All right, Mark Conter, Charlene, and Rebecca all signing off. Thank you, folks.